Good excuse to be moving around because I've been sitting around so much today, a little bit jet lagged. Thank you very much for the opportunity to speak and join you. I very much recognize that I'm standing between you and drinks, so this is a problem. If you need a drink and got to run out or get some other medication, please do so. So this topic today is one that I have thought about a long time, because many moons ago, about 20 years ago when I was a PhD student, I'm getting old now, as you might tell, my hair is falling out among other problems, I noticed that people always very much wanted to pigeonhole you. You know, even the first university I went to, I meet my new colleagues, and they would ask me, are you a corporate finance person or a microstructure person? And normally, if I can make a bit of a joke about it, the people that are a little more clever, had better programming skills, better math skills, were the microstructure people, just slightly below the theoretical people. Those are at the top of the pecking order, if I can say that. And then us lowly corporate finance folks here, dealing with endogeneity problems. But the idea, though, was that microstructure people didn't like to talk to corporate finance people, and vice versa, which I thought is very unusual, because these fields need not be as segregated as they otherwise are. And I had the good fortune spending a few years in Sydney and work with some folks in Sydney who are really very good on the microstructure side of things and do a lot of work on on market surveillance. And I learned a lot about the topic through them. So if I were to characterize myself, I'd say I'm traditionally a lowly level corporate finance person that found his way into the microstructure literature largely through my association with some good colleagues and co-authors in Sydney that if you aren't familiar with the Sydney folks, they have developed the software that is used on most exchanges around the world, as well as at many investment banks and other places, to detect market manipulation. And that surveillance software is very successful. It's a company called Smarts, recently purchased by NASD, and they have a research arm, Capital Markets, CRC, that gets universities and other things, data to those folks to enable them to do work. So, what motivated us for this particular project, we have done some of these projects which are purely microstructure-based projects, but this one led us into thinking that, there's really a lot of people in practice think that there are real consequences for how trading activity happens on stock markets, although there's less often people that link these things in our research fields. And even as I first described what we're doing to a few people, telling them about how liquidity and manipulation might have real corporate outcomes, they look at me like, no, these things are totally unrelated. So if you think things are totally unrelated, if that's your prior, my job today before drinks, hopefully in the next half hour or so, is to convince you a little bit that your microstructure models and ideas and topics could actually affect management corporate issues that we otherwise might not have made the connection before. So to do this, and I'm going to show you some evidence, and so to do this, I'm going to sort of proceed in 3 steps that I'll explain in a minute. But I just want to tell you that there are going to be concerns here that make us want to use international data. Because when these things come up, there of course are always causality issues and questions about that. And what we're going to do is use an international setting, because first of all, most work these days involve multi-country data sets. And we have a nice natural experiment that allows us to, in some ways, get around some of these endogeneity issues because of a pan-European-wide directive that implemented some rule changes for microstructure that are arguably exogenous because it's dictated out of Belgium, if you will. So these rule changes weren't isolated to specific exchanges, but rather promoted across Europe that did not happen in other places. So that makes a nice setting, if you will, to examine some of these things. So as I promised, oops, I want to go back. Nope, back. So as I promised, I'm going to tell you 3 things today. The first one is what are these exchange trading rules, and how can we make use of them in our empirical setting, particularly when you're using multi-country or multi-exchange data. And in doing so, I'm going to apologize in advance because I just found out that I'm being recorded, so I got to save all my bad jokes for later tonight after I've had a few drinks. Be more fun that way anyway. So I'm going to have to say a few unfortunate things about the politics of publishing. So hopefully my video doesn't get too widely disseminated, or said differently, hope I don't say too many bad things that I might otherwise have said. And then I'm going to really focus in on talk about the meat of what I have that's new today is on manipulation and how it affects merger outcomes, so one corporate finance thing. And then secondly, how manipulation is related to a topic of using innovation or patents is really what our focus is going to be on. And the idea of doing so is that, as I said, hopefully we increasingly see microstructure and corporate not as separate fields, but as harmonized fields. And I would say these 2 examples that I'm giving you of relating manipulation or microstructure issues to M&As and microstructure to patents might inspire you to think of other ways that these fields are connected, and we really aren't and should not be as pigeonholed as we currently are. So my first step, which I hope to go quickly, is to talk about the microstructure issues that I have found interesting in the past, and namely, these are exchange trading rules, and you might know about these rules through a market abuse directive that is part of the Lamfalussy set of directives that came out in the mid-2000s. And so what these rules are, prior to this directive, these were rules that were found on stock exchange web pages. So for example, and they currently still are found on stock exchange web pages in other countries, like in Canada, on the Toronto Stock Exchange, or on the New York Stock Exchange, NASDAQ, the Australian Stock Exchange, for the Australians in the room, or even prior to these market abuse directives, these were on all our European exchanges. So pre-2000 changes that happened, you could go to the London Stock Exchange webpage, find these trading rules. You could also go to the Spanish Stock Exchange, the Hungarian Stock Exchange, et cetera, et cetera. You get the idea. All these rules existed before the market abuse directives, but in a very weird way, despite the fact that we had all these studies of different markets around the world, people never paid attention to the trading rules of the venues in which we're actually studying. So it's very puzzling that nobody had done this before. And so what we did is we looked at all these trading rules for insider trading, such as front running, which is of course a form of insider trading. You have knowledge of your client's order. It's going to move the market, so you front run the order, amongst these other things that have direct implications for insider trading. Price manipulation rules about marketing the open, the close, prearranged trades, those sort of things. Those price manipulation rules, volume manipulation rules, things like wash trades, where the same person trades with himself or herself. It's like washing your hands. That's why it's called wash trading. Other examples of spoofing and the like. So these rules too were found on the exchanges, made better by our market abuse rules through the Lamfalussy directives. And then lastly, we have false disclosure rules, as well as rules about broker agency conduct. So again, these are traditionally found on stock exchange pages, still found on stock exchange pages, and then substantially improved through the Lamfalussy directives, which I need to say a little bit about when these changes happen. So if you're doing this for your own empirical work, it allows me to clarify a few things that have gotten confused in the literature. So there's really three possible times in which these things changed in Europe with the Lamfalussy directives, which were first put together around early 2002, and then came in mainly in the set of 4 harmonized rule changes that were implemented successfully one after the other, and very much part of an integrative framework. So these these directives are not isolated from one another, but rather part of an integrative framework. And so one way in which you might do this is this, when these rules were first proposed and the directives were first in the planning stages. Another is to look at specific times when things are put into law by the, if you will, random time when parliaments got around to signing them into law. Or you could look at the time at which they had proper surveillance and implementation of agreements that would enable enforcement. And consistent with the law and economics literature, we think enforcement is kind of important, so that's why we have looked at that in our work, although there's other work out there that came after our work that picked a different date but looked at the exact same rule change, not actually recognizing they're the exact same rule change, which led us to write a commentary about it. But if I were to just be blunt about it, is to say that this other work out there has got literally looking at the exact same rule change, just a different date. And so what we did is generate this nice picture, if you will, that if you compare the countries that did not have these rule changes in Europe and look at one proxy for liquidity, or bid-ask spreads, you see that if you pick a European-only subsample over this time period, things are going down slightly. That's going to lead you to the conclusion that those dates are important for improving liquidity. Although if you do this on a difference in difference basis for the countries that didn't experience such a regulatory change, you're going to come to the same conclusion that these rule changes implemented did improve liquidity in one jurisdiction relative to another jurisdiction, particularly in reference to this time period where we had a financial crisis shortly thereafter. So we have written a commentary paper on this, so if you're curious about that, it's happy to share that with you. So that is what we can make use of for our identification purposes, for doing other things. But I said, what can you do with these two things? Sorry, jumping the wrong way. As I said, there's two things you can do. Firstly is you can do the obvious, look at how these changes implemented impact liquidity, which has been done. Now I'm going to do the less obvious, is to link this, as I promised at the beginning. We're going to link microstructure events to corporate finance outcomes, which is what we want to do for the rest of the day. So going back again to this original quote that I wanted to motivate us today, is to say that, yeah, people seem to think that these kind of things can have real implications in practice, less often done in academics because they're so pigeonholed. So the first way I'm going to do this is linking manipulation to mergers. So how is manipulation related to mergers? And there's nothing better than an actual case to get you excited about this. So one such actual case is from Korea, where they have the very best TVs. We used to always want Sony TVs, and that was ages ago. Now everybody needs Samsung, the best company in the world for our electronics. And so Samsung, unfortunately, had a merger that didn't go very well. And what people were doing prior to the merger was essentially price manipulation, among other problems, which led to problems with the merger, and then even problems for the people that were doing this such manipulation. And as we were working on this particular paper, a news announcement came out that some of these people actually ended up in jail, which we thought, hey, this is fantastic for us as a motivating case to show that indeed manipulation prior to mergers happens. And for one natural reason, as you might guess, is that if you're manipulating things prior to mergers, it might be done as a way to set the merger price. Maybe you're going to benefit as an insider about how your shares are priced in the exchange. Maybe you think that this will enable better terms for your side of the merger. So there could be various incentives as to why you would want to do this. And our concern in this issue is to see and ask a very basic question, how often does this actually happen for M&As? And then secondly, does it help to be a dirty, rotten scoundrel and manipulate the market? Or are you better off to not do that kind of thing? And so that's what we wanted to ask in this project. And if you're, as I have joked about earlier, I'm not only a low-level corporate finance person, I'm even worse. I'm a low-level empirical corporate finance person. Really the bottom of the barrel, if you will. And so I'm not going to show you a model or anything, but I'll just suggest intuitively how this could go either way. And one is that it might help you to manipulate markets prior to a merger because it's going to make some benefits for you that'll strengthen some incentives for the merger to actually happen. That's one argument set up perhaps a little bit as a straw man. The counter is that if you do this, if you're someone that's manipulating share prices, people see this, you might infer that this is going to lower long-term equity values, arguably make share prices less informative, making everybody worried about the quality of the transaction. And then if other stakeholders see this happening, they too will become worried. And as a result, you can imagine that the chance that the merger offer is withdrawn and the merger is withdrawn goes up, and and then if it is actually executed, the deal premiums go down. And then conversely, at the end of this, we said we're interested in some look at regulation. You say, well, we've had this natural experiment in Europe with all these rule changes. Maybe this makes this bad effect of manipulation less severe or less pronounced. And so that's what we look at here. What I can tell you is, roughly how often does this happen in our sample. Just a few stats here for our completed versus withdrawn deals. So what I've shown you here is some statistics on the frequency of end-of-day price manipulation, which is where typically the price that's manipulated in setting mergers, because the end-of-day price on specific days is going to actually determine the merger price outcome, if that's going to happen. So if you want to manipulate the price, do it at the end of the day. That's a better price to manipulate. So we look at those end-of-day price manipulations, and you see that it for over different horizons. And you see it's about 11 or 12% in the 30 days prior to a merger, and 11 to 12% of the cases for withdrawn deals, and the completed deals only about 4% of the cases. And so we have some sort of a priori suspicion, just based on a simple comparisons of means tests, that indeed something bad might be happening associated with these merger outcomes. At least they seem to be exacerbating the probability of a deal withdrawal. And that's significant at the 1% level. And that's true for any sort of horizon that you would want to consider. In our case, we think the most relevant horizon is the 30 days as these deals get negotiated. You can, of course, set this up in a regression framework. So this very simple logistic regression where we look at end-of-day price manipulation cases as our main variable of interest, and then we intersect that, interact it with different exchange trading rule indices that I told you about that are not just cross-sectional. They vary across section and over time, which I stress because I've had people mischaracterize our work before. So cross-sectional time series variation. So you see the end-of-day price manipulation makes deal withdraw more likely, and then the regulation around that curtails that effect. Same thing with deal premiums. End-of-day price manipulation before a merger lowers the premium, although regulation around that manipulation makes that effect less pronounced. If you like the economic significance, how important is this? Well, in a regression framework, depending on what you control for, it's about 10 to 12% less likely. And then if you're manipulating, the deal prices are about 22 to 25% lower. So prior to M&A work, hasn't looked at these microstructure manipulation events. We think that this is connected. So I've offered you example number one, where microstructure and low-level corporate finance people could actually talk to each other and benefit one another. Now I'm going to show you one more example before you get your drink. I see you shaking there. You need a drink, I can tell. So just one more example before you can go for a drink. And oops, what happened? Yes. So again, I'm really pushing my motivation here that even in our quote from Forbes, they said diminished investment on innovation. So they even predicted this for us based on the bright insight from Forbes. And I do want to say that we're not the first people to link a microstructure topic to innovation. There's even a paper in the Journal of Finance a couple years ago that says liquidity, theme of our conference, liquidity affects innovation. And that paper actually has an unusual finding that says more liquidity, less innovation. So we unfortunately don't find that result, which I'll talk about in a bit. But the reason I highlight this is that a simple thing like market liquidity being related to innovation. So because I know I've talked to other people about this before, they say there's no way anything in microstructure is related to innovation. These are completely unrelated events. It's like, you know, the butterfly flapping its wings in Japan causes the hurricane in Florida. You know, this type of econometrics, right? And so just as our a priori issue is that these have been connected before, and I can show you some channels through which they're connected. And again, as I said, this first paper, we're going to find the exact opposite results, and I'll give you some intuition as to why that's the case. Also, I'm going to point out just initially that we presented this paper a couple other times to other folks, and they said that, yeah, we too have explored that and found the opposite results as well. So there's some issues here about how you look at patent data, and to cut to the chase is because it's hugely skewed data. That's the problem. All the results are in the outliers, which is where the problem comes in. Okay, so why might microstructure be related to patents? Because there's really two far afield type things. So we have a few suggestions, and we have two types of microstructure things that we're caring about on the manipulation side here. The first is end-of-day dislocated prices, which are one of the most commonly types of prices that are dislocated. Just as I said in the merger paper, those end-of-day prices, people want to manipulate them because it affects whether options trade in the money or not. As I showed you, just, you know, it impacts if prices are used in mergers. It can impact executive compensation, all sorts of other reasons why the end of the day price is a really important price. And the other thing is that microstructure people, I'm sure you're aware, most traders, they come into work, they're active trading in the morning, and then by about 10 o'clock they start drinking and they go to the bar, don't pay attention to anything, they go for a very long lunch, have way too many drinks, as one of my neighbors recently explained to me. They have a good dozen odd drinks, and then they come back to work at 3:30 and go crazy and trade for the last half hour to hour. And so the volume during the day starts really high at the beginning of the day, then goes down to nothing, and then spikes up again at the end of the day. So the end of the day price is really important. So then the other one is we look at insider trading. So we're actually concerned quite a bit with insider trading here. And part of the excitement with insider trading is that, almost unambiguously, end-of-day dislocation, we can think about how that harms long-term equity values, makes it harder to raise more money to finance innovation, makes prices less informative. Lots of things why you think that's bad for real-world outcomes, like innovation. Information leakage, the exact same types of things come through with just one exception, and that is, any guesses? So if Peter and I want to be dirty, rotten scoundrel, manipulators in insider trade, sort of like Martha Stewart type incentives, right? And so if we're going to, benefit from our patents, one way to benefit from our patents is to insider trade around the knowledge that we've generated a patent. And that could actually increase our incentives to become innovators if we can be innovators that are dirty, rotten, scoundrel insider traders. So that would be one reason why maybe insider trading isn't actually bad for innovation. It could be good for innovation if you can exacerbate the gains that you can get from that. And it's like there's a guy at the University of Alabama, Agrawal, who does really good work on insider trading and other things. It's like a paper he has in a recent Journal of Corporate Finance issue where he talks about people, restating their financial statements, and before they announce they've done that, they insider trade on it, of course, because they're dirty, rotten scoundrels. So it just goes to show how brazen some people can be. Okay, so that's to cut to the chase. So let me tell you, how am I doing time-wise, by the way? I carry a phone in on 10 minutes. Okay, so I'll just tell you that this is a multi-country paper that we had a really hard time with. So we got the typical intraday data from a bunch of exchanges that on manipulation, but you don't have identifiers on stock data that you can easily match to patent data. So you can do a fuzzy match on names, but a lot of the names don't match that properly. And luckily, had an excellent PhD student who worked on this for a long, long time. And I should tell you, my co-author, Rejo, the PhD student, he was such a good student and such a smart guy that he, of course, had to leave academics because he's running his own hedge fund that already has millions in funding. So he's way too smart, especially to continue working with a low-level corporate finance guy like me. Okay, so this is how we did it. P-stat data matched with the manipulation data. That's not easy. And if you're a PhD student in the room thinking of good topics to work on, you could either collect your own data, or another way to get a good project together is to merge data sets. So once you merge data sets, then you at least get a time advantage on the next guy that can easily steal your idea, like the first paper that I talked about today. Joke about that. Okay, so what is an issue here is measuring patents. And if you're not familiar with the patent work, because there are probably people less familiar in this room with patent work, I'm sure you're very familiar with microstructure, less familiar with patents, is that there's a few things you can use. You can use patents applied for and granted, and then patents cited. And then the other one that's really problematic is that there's always truncation bias. Because if we did this project and collected data up till today, then you would say, well, you don't know if it's going to be granted yet, because maybe they'll be granted next month or next year, these sort of things. So there's big truncation bias in this literature, as well as the fact that most firms don't patent. It's only about the top quartile firms patent. And then on the right tail, it's extremely skewed. Like the top couple of firms patent like crazy, and so it's a very, skewed distribution. So how you treat the distribution and getting rid of outliers can hugely affect the results. The manipulation stuff, if you're curious about this, we have lots of details in the paper. I don't want to kill things by over talking about it, but we have our dislocation looking at the last, here, let me jump ahead here, that we essentially, in a nutshell with the details on the slide, let me explain it. The last 15 days of trading, the price must deviate from the normal price by a huge amount, and then the next morning it's got to revert back to where it was before the last 15 minutes in the prior day. That's essentially our end of day dislocation measure, which shows you someone's clearly messing around with that end of day price. Then on information leakage, we have a nice benefit of this company in Australia that can take advantage of things like text mining, and we look at some parameters to decide whether there's a information leakage event that would lead to an alert that's sent to a securities regulator to investigate further. So these are not prosecuted cases, but suspected cases, because with prosecuted cases it comes up with a whole bunch of weird issues that could take forever and ever, and many countries don't bother prosecuting insider trading. So that's we want suspected, not actual cases. So we do this in terms of whether or not there's been a case before, how many cases there have been, different ways of measuring. Same thing, with the dislocation at the end of the day. Is the first time it happened? Is it repeatedly happening? And likewise, counting the number of cases. So what do we find, essentially, if you're not able to wait till drinks? Let me just tell you, end-of-day dislocation seems to be very harmful for patents. And then whether you look at patents applied for and granted, patents cited, everybody cares about citations, that's an easy one to sell in this room, and regardless of how you account for truncation. Whereas the insider trading or information leakage seems to be either insignificant or positive insignificant. So it seems to be way different than the end-of-day dislocation. And as I said, one intuition for that is that the benefits to the insider are exacerbated if you insider trade around the knowledge of your patents. The third one is that, unlike this Journal of Finance paper, we find liquidity is very positively associated with innovation. And then we also have some things just to make us feel comfortable that it's not totally wrong. If you have a country that has really good intellectual property rights, then that's good for innovation, just as a gazillion other papers have shown before us. But it's nice to see that in ours. And we, do the usual battery of checks like, endogeneity, propensity score matching, different ways of accounting for truncation, like a difference in differences test, among other things and subsets of the data. But just a couple of things on the summary stats that I wanted to highlight. So it's about a third of the sample, the way this statistic is showing you the average firm in the sample has 0.3 patents. So most firms don't patent. Secondly, how often is end-of-day dislocation for the firms in our sample? 7% of firms per year have had an end-of-day dislocation case. And then similarly with information leakage, it's, I guess about 7.8 or 9% have had an insider trading case. On the univariate stuff, and this is where I can really focus, because I know people's eyes are getting watery and you really want that drink or cocaine sniff or whatever it is you need at the end of the day. So what I'm going to show you is a nice picture that shows what's going on in the data. The picture's worth 1,000 words. So this is for end-of-day dislocation. You're manipulated versus not. So if you're manipulated, your patent outcomes are way worse than if you haven't been manipulated. And then conversely, for information leakage, it goes in the exact opposite direction. So very different types of outcomes. And then here, breaking this down for different regimes with high intellectual property rights, low intellectual property rights, same types of outcomes. You might say, well, what about by industry? What about by industry? So we broke this down by all the industries, where 0 means you haven't been manipulated, X means you've been manipulated, and you see that regardless of which industry, it's either, you know, big negative significant effect of manipulation, and then for some industries you can find a slight reversal, but it's essentially not statistically significant. Then the exact opposite thing happens for the information leakage cases, where it either doesn't matter or the manipulated ones end up doing better with respect to innovation. And you know, it'd be nice, you know, sometimes funny, you look at this in the summary stats. If it doesn't exist in the summary stats, it's not going to exist in the regressions, even though, you know, as I like to joke, if you want a result, I can definitely find you a regression that'll get that result. You know, run 10,000 regressions, I show you my best 5, and it's all good. You know, so the what I can tell you is that this is what the data are telling us in the summary stats. And yes, I've done, you know, regression starting with a simple pooled OLS, moving on to random effects models, fixed effects models, you know, and calculating the economic significance, where the end-of-day dislocation, you know, it's going to impact things by 3.5% to 7.7% lower in the next year. And then citations is more economically significant. And then, you know, so it seems to be there in our regressions. We find the opposite with liquidity, I should say, is that, you know, our liquidity estimates, oops, this way. So our liquidity estimates, even we reran a specification in the Journal of Finance paper, is that more liquidity definitely associated with more patents, which is very intuitive in the sense that, you know, more liquidity means that you're able to raise more capital, means that the innovators who are compensated with options actually are much happier, and they're going to be much more incentivized. If I haven't told you, I've recently moved to Florida, and one of our neighbors is a Monsanto innovator, and he has a huge yacht. Like, you know, so if you're thinking about quitting academics, become a Monsanto innovator, and you'll live well. So yeah, this is not what's seen in this Journal of Finance paper. What the argument in the Journal of Finance paper is that if you're more liquid, you're more subject to takeover threats, therefore you don't want to innovate more. We don't see that. We see the opposite of that. And then intellectual property rights, as I promised, that also matters. And again, more robustness checks. We become so crazy about, in our profession, about having to show robustness. So this is applied for and granted at different liquidity deciles. As I learned in microstructure, microstructure people are crazy about liquidity deciles, so you can't write a microstructure paper without showing your deciles. So doing that manipulation at different times of the year, where you might have pronounced incentives to manipulate, endogeneity specifications with two-stage least squares. You got to always do propensity score matching these days, part of our toolkit. We've done that one as well. As you see, I'm getting more sarcastic as time goes on, so I should just wrap up. So what I have hoped to have taken your time with today is my main message, as I had promised to convey, is that, you know, we're very segmented. There's microstructure people who are really, you know, smart and clever folks, and then the dumb corporate finance folks. You know, they don't need to not talk to each other. You can sort of merge these fields. It's easier for the microstructure people to do this than the corporate finance people to do this, but I think worthwhile not keeping these fields as separate as we have traditionally done so. So combining things could end up with good things. Hopefully I've moved your prior a little bit, that these things are more related than we previously thought. And thanks again for the chance to speak. And hopefully I haven't stolen too much time from drinks. Done my best. Good. Okay. Thanks. Thanks very much. Cheers. Thanks.
So, questions? Well, I have a small one. You were talking about washing your hands as one of those manipulations.
Yeah.
Would you call that like volatility or variance manipulation as well? And could it be that this has an effect on M&A deals, for example, because it's increasing uncertainty in that sense?
That's a neat way to put it. Certainly, the end-of-day dislocation will make volatility higher. If you're, even if you're measuring it intraday or across days, that'll exacerbate the volatility. I think if you're trying to give the stock the appearance of being a riskier stock, then that would be a good way to do it. But to be honest, despite thinking about this manipulation stuff for many years now, I haven't framed it in my head as volatility manipulation. So that's interesting. That'd be a good way to, I think, if you will, kill an M&A deal, for example, if you're doing it like that. And one thing is, as I've seen today, I really focus on end-of-day dislocation and insider trading. There are all these other types. We actually can measure wash trades in the data and other ones. And I think even though those are perhaps slightly less common, they with 40 odd types of different manipulations, you end up doing kitchen sink econometrics, which we try to avoid, but we might think of that more in the future as we go ahead, that's for sure. Indeed, that'd be a fun one to think about, that's for sure. Yeah. The other thing I didn't talk about, maybe I should have a little bit more, is that just in case you get into this patent literature, just to highlight this really crucially, the outliers are driving everything. So you got to be very cautious about any patent paper that you read. You're very suspicious, because as I said, 3/4 of the firm have 0 patents, and then you only get up to the top 1 or 2 percentile, and then they have way more patents than everyone else in the sample, and so it could be very suspect field. And because the video's on, I have a great joke about outliers, but I don't want to tell you because the video's on. It's a bit of a racy joke, so I'll tell it over dinner maybe. Yeah. Hilarious. Yeah.
Recently, I attended a World Bank presentation where the presenter had a particular Chicago school neoclassical perspective on research and development and innovation. And they were showing on their graph over the last X number of years a block between R&D as a percent of GDP basically rising.
Yeah.
Now I was critical of that because they weren't separating out government from private sector R&D. And so, for example, because I'm a bit of a nerd, I look at physics today on a regular basis. And 1 month or so ago, they had on the cover page, they had the neutrino tracking station being developed in Japan.
Yeah.
And this antenna was being built underground at a cost of $500 million US. Right. So the key point is that clearly your point about country level differences matter a lot, and I'm wondering whether it's in fact leading with government support.
Fantastic question. And I'll admit I've done a bit of work on patents and R&D in the case of China for state-owned versus non-state-owned firms. Just finished up an R&R on that project, and So I should be more sensitive to this topic than I have been in this paper. You know, as I sit here and bite my tongue, I think that could be quite crucial and interesting. In fact, as I think about it, you know, relate this back to microstructure issues, I don't think many have really looked at microstructure properties of government-owned, state-owned firms versus non. So that's angle of the data that we've ignored, and perhaps badly, but it shows the value of presenting, because you know, get ideas that you didn't think about, which is I'm sensitive to, you know, now that we've talked about it, I think this is worth thinking about more, and maybe we could finally work on something together. That'd be a good one to think about. It'd be interesting. Yeah, I can imagine, you know, coming up with some stories in my head. I can imagine that in certain places there could be a pronounced incentives to, for example, insider trade if you have some specific government knowledge that would influence some of the direction of things that we had talked about here. So that's interesting.
Well, of course, in our early paper, on the government being able to, so people within government being able to access any information.
Exactly. Yeah.
Of course, that never happened.
Yeah, no, that's, but yeah, perfect topic, something we need to think about more. Yeah, great. Thank you. Much appreciated. As I said, best thing about coming to these conferences and presenting is you get meet smart people and talk about ideas you didn't think about. So it's great to be here. Thanks again.
Okay, so any other questions? If not, so I can turn over to Peter.
Yes, so I just would like to thank everybody.
Thanks again. Thank you.